kind of fun. We'll start off with looking at the odds of November being positive were 100% in the past 10 years. Well, guess what? No, November was negative on the very last day of the month. It went down enough to make the market negative for the month. So that went away. And it was down 0.7, 0.8, depending which version of the index you're looking at, but it's somewhere in that area. So that's, the odds were in the favor, but it just didn't work out. December is also a good place for odds going forward. We'll see where it goes. I really have no strong feeling that with the Fed announcement yesterday, I'm very on the fence of, I thought the news was bad, but apparently the market thought it was good yesterday, but today it's not so much anymore. So we'll have to see how this plays out, but I'll show you what the data tells us. And we really go by the data at the end of the day anyway. So let's take a look. All right, long-term trend. Long-term trend has been ugly since mid-November. The run-up, which we caught a lot of, and I'll show you a little bit more of that later. Right around the 15th, I believe it was, just straight down of money just coming out of the market fast. And this is kind of our line in the sand. This I believe it's a 55-day moving average. If we're below that, then you really want to kind of be playing it safe. Volatility is going to be elevated, and just the market's going to be crazy. Right. And that doesn't necessarily mean up. Sure. So typically markets go up on low volatility and they go down on high volatility. So we keep a lot of the reasons why we look at this data tells us the context of, is it high volatility or low volatility in the current market environment? So we are back to being below this line. It's trying to go up, but earlier this morning, but now it's still down here. Our midterm cycle, this is money flow coming in out of the market. Again, around the 15th, we had a sell signal to say, hey, let's just take it easy. It tried to go positive a couple of days ago, just did not do it. Tried to go positive this morning, couldn't do it. So I'm a little bit concerned of where we are going forward. We are generally defensive. And those that you don't know, we run our enhanced index models off of this strategy completely. So this is kind of what drives the thinking. So do we want to be in the market or out of the market? And that's a supplemental strategy, so it's not really our whole thing, but I like to give us context. Do we want to be nudged into our full allocations? Do we want to be backed out away? So that's kind of what helps us in our allocations to keep things the risk managed when things get interesting or higher, more volatility. So I had somebody ask me last month to show when these signals happened, right? We had a negative signal, then positive and negative, and then we were positive for a while. Right here, and then we were negative since then. So I did little boxes on the chart so you can kind of see where that happened. So here's where we had, expected higher volatility, and yes, there it was. Big volatility tried to come back. We did have one day of maybe okay, which we talked about last month, but no, volatility returned. But coming out of this box, when things were green, this whole mountain, that's when this happened. And we caught a lot of that. I'm really happy that we did. So that really improved our numbers for the year. And then since about, I think it was the 15th of November, we've just been back to be, who knows, it's choppy. We had a good day yesterday, but today is giving it back. So volatility is weird. But I also added on the average true range to this chart just to kind of see it. When volatility is expanding, that typically corresponds with the falling market. And when the volatility is falling, that goes with a rising market. And then again, we have rising volatility again. Things are messy, and it's really just kind of unsure at this point. The ATR is the average true range of the last several days. So what that looks is how much movement is happening day to day and how to deal with that. And it gives you the context of where the market is. So again, typically rising volatility, bad for the market, falling volatility, good for the market. So we did catch that. And now we're back to playing it safe. I'm not sure why we can't seem to get a good run into the end of the year, the typical Santa Claus rally, which would be amazing, but it's just not happening. All right, so finally, I believe we're going to look at the sectors, positive to negative. That's 5 to 6. Again, the technology is still the leader, although today it's a little bit messy, but it's still one of the strongest sectors in the area. Same with real estate, utilities, and healthcare, and consumer staples. Now, a few of these are more defensive, so that's also not real positive about the market being strong. So we'll see where that plays out. But generally, this is kind of a mix of defensive. It's not telling us that the market's real strong here. And then we do get good days of goodness, but they're being offset by the next day. So that's kind of what we've been dealing with lately in this higher volatility environment. And on the other side, we have a few of the inflation staples, which I think is interesting because theoretically we should be seeing strength in things that are good in the inflationary environment, but we're really not. Right? Basic materials are a hard material that you can own. They're kind of weak. I mean, they're trying to go positive, but they're still on the side, which isn't good. Energy is typically a staple, and usually financials do well in a rising rate environment as well. Banks can make more money when that's happening, but we're just not seeing the strength in those sectors. So I'm not sure why. And at the end of the day, we follow the data. I mean, I can project and say, hey, inflation's going to do this, so we're going to invest in that. And we really don't. I go, what's strong and what's not, and we just go from there.